Welcome back to Total Money Management, part 3 of 4 of
Beautiful.
how to think about investing. In this one, we're going to give you some more practical tools, some calculations, some numbers, something to actually think about.
Bit of homework.
Yes, bit of homework for
It's
people.
not all just listening to us rabbit on.
God.
Well, you, I have valuable information.
I do that for a living, mate. Listen to you rubbing on. Yeah, so by the end of this one, you should be able to at least turn a piece of paper over and write some calculations down and actually give yourself some figures, particularly around property. So the pitchforks will probably come at the end of this one.
Haters gonna hate.
Yes.
Get out there, you people.
But yeah, you have to let us know what you think. Anyway, so let's kick off. So stocks,
Beautiful.
expected return.
Love them.
I'm a long-term investor. How do I calculate the expected return, Steve?
Okay. The first part is, let's say you can't sell the asset. I always like doing this because it's really good with ETFs, country indexes, but it's also the way, as we talked about in the last session, about discounted cash flow.
Yes.
Right? Because the base rate is, I shouldn't say base rate, the base understanding is, let's pretend you can never sell the property, or the stock, what would the yield be? So if I said Jacob gets 10%, you would go, okay, in 10 years he's bought that thing and then the rest of it's gravy. If I said 5%, you go, okay, 20 years to pay it off, right? If it's 20%, 5 years to pay it off, right? So that gives you the idea.
That's a good exercise. Yeah.
Okay, so there's theoretically no capital gain. So you calculate the base rate or the average long-term dividend yield, right, or the rental yield. Okay, same thing. So you say, okay, stocks I think is around 4% in the US, a little higher in Australia. Okay,
Right.
so that's your base figure. If I invest now and hold it for the long term, what should I get? Well, it depends on the price, but generally you want to be getting 5.
Yeah, if I
Right.
invest now, hold it till I drop dead.
Yep, you'll generally
get
probably
about
get 5, right? Okay, next part, calculate the expected capital growth over the long term. Same thing. Oh, this company's been growing at 3% per year. Okay, well the dividend's 5. Okay, 5, 3, 8%. Okay, and then you'll knock off a bit for costs and inflation and stuff.
Yeah.
Right? Okay, you can do the same with property. Okay, what's the rental yield? Oh, it's 2%. Okay, 2 plus, and what's the capital gain? Now, as we said in the last thing, you might go, man, it's 20% per year. It's like, I'm holding it forever, and the long-term capital gain is 2%. Okay, so really I'm getting 2 plus 2. Now, in the short term, I might get 2 plus 7,
Yep.
or
2 plus 20.
2 plus minus 5, right? Depending where you buy.
Yeah.
So if we use the base rates, right, the long-term S&P earnings yield is 7.5. Now, just bear in mind at the moment you're getting about 2.5, right? January 2025. That's where you're saying, man, someone's paying a lot of money to buy that little skimpy 2.5%, right? That's where you can say, well, Jacob, I'll offer you 4.5 in bonds or 5 in Macquarie, right? And you go, okay, well, why am I putting it in the S&P at 2.5?
If you're using the mindset of I'm never going to sell this.
Yes. And even depending on your time frame. Right. So if you have a look, this one is really important because we talk about it a lot, which is, listen, folks, there's periods where the stock market goes nowhere for a long time, right? And it's always because at the top of the market, right? And everyone's going, man, it's NVIDIA and AI, it's going on forever. And then it blows up because the Cape's at 40, right? So if you can spend a lot of time getting back to where you bought it if you buy at a high price, which equates to a low yield.
But Steve, I'll just dollar cost average on the way down.
There you go. So not all of us are young enough to dollar cost average for the next 30 years to recover from the mistake of buying when the market's too high.
It's still about, even if I dollar cost average in for the next 13 years, I'm still averaging at a price that I paid at the high point. If that
you
makes
might
sense.
recover. See, if you look at 2000, the Cape was at 44 in 2000. Then it halves, right? It goes down to 23. You lose 50% of your money in 3 years, right? The NASDAQ lost 80%, right? Then it bounces over the next 4 year, it doubles, right? 25% per year. Woo, this is good. Now you're back square, right? Okay, it's all good. We're going back again. But the Cape's at 28 and it falls with the GFC down to 13. So in the 2009, I've gone down 50, up 100 and down 50, right? I mean, what a roller coaster, right? And you've lost basically 5% per year.
Yeah.
Right? Why? Because you bought it high in 2000. But now, I think as we talked about last week, now you jump in and you make 12.5% per year.
Isn't it interesting though? And I'm going off script a bit here, but so you got the 52-year zero returns.
Yes.
Then that basically halves to 26, and
Yep.
then that halves to 13.
Yeah, good point.
And then
The next one might be 6.
the next one might be 6.
It could be.
Is it because there's just more money
Well,
flowing in?
yeah, and in things like inflation and interest rates and stuff. See, I've said this before. I've been trying to work out just in the current period, how would the Cape fall from 30 if the US is performing really well? And I think I'm warming more to the idea there of 65 to 82, which is a slow, long decline. And most of that was basically from inflation, right? And I think we're probably going down that track again.
Right.
And the reason why is because we've had record company profits and inequality for a long time. And I think that's going to have to be rebalanced somewhere along the line.
With a slow burner.
Yeah, and I think it's with the erosion of corporate profits over time going back to labour. In other words, higher wages and lower profits means less stock market returns for the investor.
That's interesting.
Okay.
Yeah.
This one here, just showing you like the last one, this one just showing capital returns in the ASX from 07 to 22. And again, excuse me, in 2007, our Cape ratio was 31, right? It's the highest it's ever been. So we spent a long time working off that valuation.
Like deflating it. So
Excuse
that's
me.
11.8% from 27 to 2022.
Yep. Now, I put that on Twitter and got people were, you raving lunatic, there's dividends. And I say, okay, yeah, there's dividends, that's true. And there's inflation, so let's cancel that out. Okay, but people dollar cost average. And it's like, okay, but they're still getting shithouse returns. That's my argument. My argument's like, okay, well, dollar cost averaging means you'll get average returns.
Yeah.
All right, well, that's fine if you want average returns. But most of us want to get better than average returns.
Yeah.
And again, just in simple logic, saying, well, like in that period, if you'd have bought an Australian property, you'd have done unbelievably well.
Instead of the market.
Instead of the stock market, right? So again, if the stock market's really expensive, there's other places to invest. But what I'm pointing out here is the capital returns, right? If you don't rebalance, you will not get those capital gains because when the market falls again,
like these big periods.
Yeah. Right. So in 2020 there with COVID, we fell from 6,500 down to 5,000, right? Well, we lost all of those green bars on the way up, right? And yeah, you get dividends and stuff, but as I said, you get inflation and charges and taxes and,
And when we were here, no one knew that it was going to V-shape.
Yeah, no one was realising it was going to bounce back 30% in, like look at the green arrows afterwards.
Yeah.
The green candles, right?
All right, so property expected returns. Property income's fairly predictable, I mean, you can say. The valuation exercise just needs 3 numbers. So we've got discount rate or rate of return required by an investor, net rental income generated, and long-term growth rate.
Yep. If you've got those 3, right, get a piece of paper, get a pencil.
Write them down,
and we're going to plug them in.
Yep.
Right? And this gives you a bit of a rough argument about what you can expect. Rough enough, or I should say close enough, where you go, okay, I'm ruling this out because I'm only getting 2%. Right? So
you can do it quickly on the back of a postcard and go,
Well, you just need to know the long-term values, and that places you, like we do with stocks, right? The earnings yield generally is 7. Well, I'm getting 2. Okay, well, the price is way expensive and I'm out.
Yes.
Right? But you've got to know that the long-term base rate is 7. right? And that's all we're doing here is saying you can plug these numbers in to give you a bit of an idea, right? So that's what we're doing here. A discount rate reflects the rate of return an investor needs to compensate them for the risk of investing in a particular asset. So the discount rate is just, what am I going to make?
Yep.
Right? I want 10%.
Yeah. So a good way to estimate it might be to start with the 10-year government bond rate, which is a proxy for the rate that applies when there is no risk.
Yes.
Which is currently, what, 4?
About 4.
Yeah.
So what I'm saying there is, well, you come along and say, Steve, I got $1 million. What do I do? And I say, well, Jacob, you can get 4% in a government bond. Okay. But listen, mate, why don't you buy a property and you'll get 1? Now you would go, that doesn't sound like a good investment, Steve. Right. And that's the importance of getting the anchor to say, what's the risk of buying a property if I'm only getting 1%? Now, that can be countered by saying, yeah, but Jacob, the price of the property is going up 7% per year. Oh, okay, so I'm really getting 8%. Yeah. Oh, okay, well, that's different.
Yeah, so for argument's sake, you've got a risk premium of 4 and you've got 4%. It gives you a required rate of return of 8%.
Yeah, so you say to me, well, Steve, I can get 4 in bonds. Listen, mate, I want this stock or the property to yield 4% over that. Okay, well, Jacob, that means you want 8%, right? Or thereabouts, okay? Long-term average.
Yep.
Now, okay, so we know what you want now. You say, Steve, dude, I want 8%. I say, okay, the net rental yield, right, is roughly about 4%.
Yeah, in capital cities.
In 2015.
Yeah.
Right, so at the moment, excuse me, it's about 2.5 to 3.
Oh, is it? I haven't looked at it.
In fact, it's probably lower. So in other words, that's, fairly unattractive.
And this is in capital cities as well.
Yes. Yeah. So next slide.
Next.
Righto.
Bang.
Okay. So now to calculate the net rental yield, subtract all the expenses that an investor must incur. Okay. So you're talking about property management fees, maintenance, insurance, capital costs, right? The loan, all that sort of stuff.
So
okay?
1% is a reasonable number to deduct.
Yeah. So you say, okay, the net yield is 4. Right, but it costs me about 1. Okay, so the real yield is about 3.3.
Yep.
Okay, so that's the final number required is the long-term growth rate in rent. Okay, as shown in the chart, which is not here, the figures above 3 may be reasonable. Okay, so let's assume 3.2. So in other words, I'm putting the rent up 3.2% every year.
Yep.
So now I can calculate the valuation. Right, so put them together. Divide the annual rent earned on the property, right, by the divisor, which is calculated by subtracting the long-term growth rate from the discount rate. Let me give it to you in short, right? Yeah. And we've written it up there. Value equals the net rent per annum divided by the discount rate, 8%, right, which is what you want, and the growth rate. Okay, so this is the formula for calculating the net present value of the stream of cash flow. Right, Jacob, you're never selling this property. This is what you're going to roughly make. Okay, the property generates $20,000 per year of net rent. Right, so it might generate 25, and we say, yeah, 5's for maintenance and blah, blah, blah. So I end up with 20, right? We would calculate the value, right? This is the important part. Okay, it's 20 grand, right, divided by, in brackets, the discount rate, 8, minus the growth rate.
3.2.
Right. Okay, so now we've got 20,000 divided by 4.8%, which is 8 minus 3.2, right? Equal to around 416,667. Okay. Let's go to the next one.
So that's what I want to pay.
If you want your 8%.
Yeah.
Right? Okay. If the property can be bought today at a net yield of 3.3, it would imply that the market price of the property is 20,000 divided by 3.3 equals 606. Okay?
Which is way higher than the 416, so it's overpriced.
Exactly. Right? So you said I want 8 and you're basically getting 3.
Yep.
Right? Over the past 3 decades, there's been a 4-fold increase in Australia's indebtedness as a percentage of annual disposable income to 150. I think it's now higher. These slides are a bit old. as well as massive growth in property prices, right? Given mean reversion, it wouldn't be prudent to assume continued capital growth. So what we're saying there is, look, you can use these really simple figures just to go boom, 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 right? Now, you can say to me, Steve, this is a growing suburb and the Olympics are coming and, this is going to continue and all that sort of stuff. No arguments. All I'm doing is saying, but Jacob, if you're going to hold this property for a long time, you're going to not generate a very good yield because you're paying too much. That's where that's what people are doing at the moment.
Yeah.
Right? Because they're looking at the yield. They're not looking at the yield. They're going, yeah, but Steve, this guy bought it for 500 and is selling it for 800. And it's like, yeah, he's the one that's made all the money.
Yeah. But if you did this simple calculation, it'd give you make you a little bit wiser.
Yeah.
I mean, average rent. I mean, 20 grand's average rent now is what, 60 grand a year or something.
Yeah.
We're getting it. So.
Well, that's the importance of saying I'm going to plug in the figures and see what its value is, not what its price is. The price doesn't tell you anything. It's the value that tells you something as an investor.
Yeah.
Right? I love that house. It's really nice and it's $1 million. Okay, so what? What's the rental yield? What's the capital growth? I'm an investor. I don't care if it's a nice Art Deco property or whatever.
Yeah, I'm not going to live in it for the rest of my life.
Yeah. It's an investment, right? So you have to look at those numbers, and that gives you a fairly easy way of saying, I've calculated if I want 8%, I'll pay $416.
Yeah, you can.
How much you want for it? $660. 606. It's like, okay, dream on.
Yeah, I've got to hope or speculate that the capital gain is going to continue.
Yeah.
If I want to sell it, I mean, this is something you can put in a simple spreadsheet. There's 3 or 4 little plot points, and you could have it for each property that you're looking to invest in, and it'll spit out what.
Absolutely.
You could actually find one that makes sense.
And that's why I say you've got to think about the rental yields. Right? How do they fluctuate over time? So we know the last few years have been absolutely great for landlords. But counter that with, but the interest rates have gone from, 0.1 to 3.5. Okay, so the landlord, and this is what I'm saying, the landlord charges you an extra $100 a week. You go, oh man, that's outrageous. And it's like, mate, the poor old landlord's got to find $400 a week because of the interest rate. That's where you've got to work that stuff in, and that's why it was dangerous to borrow when money's really low. Because if you're holding for a long time, you have to say, okay, our interest rate's going to stay at 0.1 forever? No. Okay, well, you need to factor that in, and that's where a lot of people got caught in property, right? Because they borrowed it at 1 or 2%, and then the RBA said, now we're knocking it up to 4.5%. And so now people are paying 6%. Right. And you didn't have that in your calculation because you weren't using the long-term base rate figures.
Yeah, you're using the here and now.
Yes. And that's where you go, oh, yeah, but it's all good. Mate, the RBA won't put up rates. And that's why I'm saying, how long are you going to hold the property? 20 years. Okay, so what you're saying is they're going to keep interest rates at 2% for 20 years.
Or lower, yeah.
Even if you say, well, and this is what happens, even people say, yeah, but on average, and it's like, mate, if it goes to 6%, it's no good saying to me, oh, yeah, just hang on another 10 years, Jacob. It's like, I'm paying out an extra $500 a week now.
Well, if it's 6% at $1 million, it's a lot different than 6% on 100,000.
Yeah, absolutely. So it's, investing is a rational pursuit, as we talked about in the first one. What you want to do is do the numbers, and you've got to be really cold-blooded and say, hey, this is not worth it. All right, okay, it's not worth it. We'll leave it alone.
Yeah.
Most people try to sort of fit it in a bit, right? Like it's like, yeah, but I really like the place. Yeah, and we can borrow money. Yeah, and they start squeezing all this stuff in, and before you know it, they've convinced themselves that they're buying this property with a yield or a stock that, is a bloody speculator.
Yeah, and look, we've gone a bit time. I think what I'd like to give to the audience is, if you want us to give you the plot points, we can put them on like an email or a spreadsheet or something and send it out to people. Yeah. Email us.
I'll put it on the socials if you like.
Put it on the socials or email us if you want to have a further chat, and we can send you like a spreadsheet or whatever we're looking at, and then you can start to do some back testing on your properties.
Yeah.
What are we looking at next week, Steve?
We're going to delve in a little bit more into the cycles, the cyclical stuff, interest rates. You know, again, I'm always harping on about value versus price, but it's really important because the price, as I say, doesn't tell you anything, right? You want to know the value. You know, if I pull up in a Mercedes and I say it's worth 120 grand, it's like, well, so what? That's the price of it.
Yeah.
If I said, Jacob, you can have it for 50, you'd go, okay, I'll buy it.
Yeah.
If I said you can have it for 200, you go bugger off.
Yeah.
Why? Because you you're looking at it going, well, that's bad value.
Here's an investment. I'll just go and sell it for 100.
Yeah, well, do what you did with your Mustang.
Oh, that was
buy it for 60 and sell it for 80.
All right. We'll see you guys next week. Thank you.
Cheers, folks.
As always, remember, we don't provide financial advice.